Welcome to this YouTube channel. In this video, we are going to talk about how to invest in stocks for the long term. Before starting this video, like this video and subscribe to our channel for future updates. Investing takes time. If you want to invest for retirement or grow your savings, it's best to set it and forget it. But long-term investment isn't as successful as throwing money at the stock market. Here are some recommendations to help you get started. Please note that the information shared in this video does not in any manner intend to be taken as a piece of investment or financial advice. The content in this video is so curated to suffice for the purpose of being informative and educational. You are requested to conduct your diligent market research or consult an expert in this regard to make better investment decisions. With that being said, let's get into it. Number 7. Get your finances in order. A long-term investment requires knowing how much money you have to invest. That means organizing your finances. An investment portfolio shouldn't be recommended until a client has gone through a full financial planning process, says Taylor Schultz, a San Diego-based CFP and host of the Stay Wealthy podcast. Begin by assessing your assets and debts, create a realistic debt management strategy, and calculating your emergency fund requirements. This ensures that you can put money into long-term investments and not need to take money out for a long time. Early withdrawals from long-term investments undermine your goals, force you to sell at a loss, and may result in costly tax consequences. Number 6. Know your time horizon. Everyone has varied investing goals: retirement, college tuition for kids, home down payment. The key to long-term investing is knowing your time horizon, or how long before you need the money. Long-term investing is usually defined as 5 years or more. Knowing when you need the money can help you decide what investments to make and how much risk to take. A CFP with Urban Wealth Management in El Segundo, Khalif says that investing in a college fund for a child who is 18 years old can afford to take on greater risk. Their portfolio has more time to recover from market volatility, she explains. Number 5. Pick a strategy and stick with it. After determining your investment objectives and time frame, commit to a strategy. It may also help to split your entire time horizon to inform your asset allocation decisions. In New York City, Stacy Francis, president and CEO of Francis Financial, categorizes long-term investing into 3 categories: 5 to 15 years away, 15 to 30 years away, and beyond 30 years away. The shortest timescale should be invested carefully, with 50 to 60% stocks and the remainder in bonds, Francis advises. The most aggressive could go up to 90% stocks. I like having rules, Francis explains, but in the end, you have to do what you want. It's crucial to select an asset portfolio that you are comfortable with so you can stay to your plan no matter what. There is a lot of dread and anxiety when the market goes down, Francis says, but locking in losses and selling is the worst thing you can do. Number 4. Understand investing risks. Before investing in any asset, make sure you understand the risks involved. Stocks, for example, are considered riskier than bonds. So, Francis advises reducing your stock allocation as you near your target, thus locking in some benefits as the deadline approaches. Some stock investments are riskier than others. Because of the greater economic and political uncertainty in other places, US stocks are regarded to be safer than those from other countries. Bonds are less hazardous, but not 100% safe. For example, corporate bonds are only as safe as their issuer. If the company goes bankrupt, bondholders may have to bear the loss. To reduce the danger of default, only invest in bonds issued by corporations with good credit ratings. However, credit ratings are not necessarily the best indicator of risk. Investors must also examine their own risk tolerance. It includes being able to watch the value of one's own investments fluctuate without losing sleep, King explains. Even highly rated firms and bonds can underperform. Number 3. Diversify well for successful long-term investing. Spreading your portfolio across multiple assets allows you to hedge your bets and increase your odds of holding a winner at any one time. We don't want investments heading in the same direction, Schultz says. Diversification is the goal of our investments. Your asset allocation probably starts with equities and bonds, but diversification goes deeper. Investing in stocks can include, among other things, the following. Large company stocks are those with a market valuation of over $10 billion. Mid-cap stocks are those with market capitalization between $2 billion and $10 billion. Small-cap stocks are those having a market cap under $2 billion. Growth stocks are stocks whose profits or revenues are soaring. Value stocks are those with a low price-to-earnings or price-to-book ratio, which analysts, or you, believe represents a company's underlying worth. Stocks are a mix of the above, combining size and investing approach. You can have high-value stocks or high-growth stocks. The more diverse your investment portfolio, the higher your chances of positive long-term returns. Mutual funds and ETF diversification. Investing in funds rather than individual stocks and bonds can increase diversification. Mutual funds and exchange-traded funds, ETFs, make it simple to diversify your portfolio among hundreds or thousands of equities and bonds. True broad exposure requires owning a lot of individual equities, which most people don't have the funds for, explains Francis. One of the best ways to acquire that diversification is through mutual funds and ETFs. That's why most experts, including Warren Buffett, advise customers to buy index funds, which offer affordable exposure to hundreds of companies' equities. Number 2. Mind the costs of investing. Investing fees can eat into gains or losses. When investing, keep in mind the fund's expense ratio and any management fees charged by advisors. Buying individual stocks, ETFs, or mutual funds used to require trading fees, but they are increasingly rare. Funding ratios. Investing in mutual funds and ETFs requires an annual expense ratio, which is the cost of running a fund. These are usually reported as a percentage of the fund's total assets. Schultz advises looking for investments with annual expenses below 0.25%. Some funds might also add sales charges, also called front-end or back-end loads, depending on whether they're charged when you buy or sell, surrender charges if you sell before a specific time frame, or both. If you're looking to invest with low-cost index funds, you can generally avoid these kinds of fees. Financial advisory fees. If you receive advice on your financial and investment decisions, you may incur more charges. Financial advisors charge a yearly management fee based on the value of your assets. This is usually 1% to 2% per year. They charge 0 to 0.25% of your assets, although they tend to have fewer services and investing possibilities. Fees, long-term effects. While each of these fees may appear tiny on their own, they add up over time. Imagine investing $100,000 for 20 years. Using a 4% annual return, paying 1% in annual fees leaves you about $30,000 short, according to the Securities and Exchange Commission. With the same 4% annual return, you would have earned an extra $12,000, giving you nearly $40,000 more with the lower-cost investments. Number 1. Review your strategy regularly. Even though you've committed to sticking with your investing approach, you must frequently review and change. Quarterly, Francis and her team of analysts analyze their clients' portfolios and underlying assets. Your portfolio can do the same. While passively investing in index funds may not necessitate quarterly checks, most advisors advise at least a yearly check. When reviewing your portfolio, verify that your allocations are still on track. Stocks, for example, may quickly surpass their targeted portfolio allocation and need to be reduced. If you don't update your assets, you may end up taking on more or less risk than you intended. Maintaining your strategy requires regular rebalancing. Make sure your investments are still performing as expected. Francis recently identified a bond fund in certain clients' portfolios that was investing in garbage bonds to improve returns, which have the lowest credit ratings, making them the riskiest of bonds. She dumped it because it was too risky for their bond allocation. Watch for changes in your own life. A financial plan is alive, Schultz explains. Changing circumstances in a client's life require periodic review meetings to ensure that changes in their financial condition do not affect how their money is invested. End of long-term investing. Overall, investment is about focusing on your financial goals and ignoring the markets and the media. What does that mean? It means buying and holding for the long term, regardless of any news that would tempt you to attempt to time. I don't think investing is thinking about the future 12 or 24 months. A CFP and owner of Unique Financial Advisors and Tax Consultants in Holmdel, New Jersey, vid Panapoli. Investing for the long term is the only way. What do you think about this video? Let us know down in the comment section. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.